Your money-making broadcast starts now. Welcome to the May 16th market recap. Markets closed sharply lower today in a broad sell-off driven by renewed inflation fears and a sharp jump in bond yields. The Dow fell 1.1%, the S&P 500 dropped 1.2%, and the tech-heavy Nasdaq Composite slid 1.5%, while small caps bore the brunt with the Russell 2000 plunging 2.4%. The sell-off was broad-based, with 9 of 11 S&P sectors closing in the red, as investors grapple with the reality that inflation may not be cooling as quickly as anticipated. 10-year Treasury yields spiked above 4.6%, their highest level in months, putting pressure on growth stocks and risk assets across the board. Let's break down what happened and what it means for your portfolio. Story 1: Inflation jitters and the bond market shock. Global markets tumbled as bond yields surged on fresh inflation concerns. The catalyst came from hotter-than-expected producer price data and comments from Federal Reserve officials signaling that rate cuts remain distant. The 10-year Treasury yield jumped above 4.6%, its highest since late last year, triggering a broad-based risk-off move. This is exactly the scenario we flagged in our previous analysis. The S&P 500's relative strength index had been sitting at an overheated 82 to 83, a classic warning signal that a correction was due. When yields rise sharply, growth stocks get repriced first because their future cash flows are worth less in a higher rate environment. That is precisely what we saw today, with the Nasdaq suffering the steepest declines among the major indices. The ripple effects were global. Asian markets closed mostly lower overnight, and European bourses followed suit during their trading session. The synchronized nature of this sell-off tells us this is not a US-specific issue. It is a global repricing of risk as the market digests a higher-for-longer interest rate reality. Adding to the macro uncertainty, oil prices edged higher as markets focused on the upcoming Trump-Xi meeting in Beijing. While a potential trade breakthrough could be positive, the uncertainty itself is keeping investors on edge. The Citi CEO recently traveled to China with the president, and Beijing finally approved a long-delayed deal, signaling that diplomatic channels are moving. But markets hate ambiguity, and right now there is plenty of it. Story 2: Semiconductor bloodbath and tech sector pain. The semiconductor sector was ground zero for today's sell-off. Intel plunged more than 6%, AMD cratered nearly 6%, and Broadcom fell over 3% as the entire chip complex came under intense pressure. The selling was driven by a combination of rising yields, profit-taking after an extended rally, and company-specific concerns. Cisco's announcement that it plans to cut thousands of jobs as part of an AI-focused restructuring added to the unease. Even a company delivering an earnings beat is slashing headcount, which raises questions about demand visibility across the broader tech ecosystem. The sell-off in semiconductors is particularly noteworthy because this sector has been a market leader throughout the current bull cycle. When leaders falter, it often signals a rotation, or worse, a more fundamental shift in market direction. Cerebras, the AI chip startup that went public earlier this week with a blockbuster IPO, saw its stock slide sharply today, reminding investors that the AI euphoria trade has limits. Qualcomm bucked the trend with a surprising gain of over 8%, though that move appears to be driven by company-specific news rather than broad sector strength. The broader message is clear. After the massive run-up in tech and AI-related names, the market is demanding proof of sustainable demand, not just promises. The semiconductor bloodbath reflects a market that is reassessing valuations across the technology landscape, and the pain may not be over yet. Story 3: Energy strength and the defensive rotation. In stark contrast to the tech wreck, the energy sector was a bright spot. ExxonMobil climbed more than 3%, making it one of the best-performing stocks in the S&P 500 today. The move higher was supported by rising crude oil prices, as supply concerns and geopolitical uncertainty surrounding the Trump-Xi meeting pushed West Texas Intermediate crude above $78. This is the classic defensive rotation. When inflation fears hit and yields spike, investors flee high-multiple growth stocks and pile into sectors with pricing power, tangible assets, and inflation hedging characteristics. Energy fits that bill perfectly, and ExxonMobil's integrated business model gives it additional resilience through both upstream production and downstream refining margins. But it was not just energy showing strength. Solar stocks saw a massive breakout, with Enphase Energy surging more than 10%. This is a fascinating counter-narrative. While the broad market panics, certain pockets of innovation are catching bids. The solar move appears to be driven by policy expectations and improving fundamentals in the clean energy space, suggesting that thematic investing around energy transition remains viable even in a risk-off environment. Meanwhile, Ford Motor Company fell over 7%, extending its losing streak as the auto sector contends with demand concerns and competitive pressure from Chinese electric vehicle manufacturers. Rocket Lab also saw a sharp decline of nearly 6%, reflecting broader risk-off sentiment hitting even high-momentum space economy names. The divergence between energy winners and tech losers tells a clear story of sector rotation in action. Market analysis and perspective. Let me put this into perspective with our market analysis. In our previous briefing, we flagged a 65% probability of a short-term correction, and that call has been confirmed today. The S&P 500's RSI was sitting at an unsustainable 82 to 83 level, deep into overbought territory. When you combine extreme overbought conditions with inflation scares and rising yields, a pullback was all but inevitable. What we are seeing now is a healthy, if painful, reset that relieves some of the built-up froth in the market. However, it is critical to understand that this is not 2022. We are not looking at a structural bear market driven by runaway inflation and aggressive Fed tightening. Today's sell-off is better understood as a late-cycle bull market correction. It is a necessary cooling-off period after an extended rally that took the S&P 500 to levels that were pricing in perfection. The key question going forward is whether the index can hold support near its 50-day moving average, which would signal that the underlying bull trend remains intact. We also need to watch the VIX, which is likely to spike in the coming days, and monitor whether selling pressure intensifies or stabilizes in the sessions ahead. The late-cycle warning signals we have been discussing, including parallels drawn by investors like Michael Burry about potential bubble dynamics, are worth keeping in mind, but they do not necessarily point to an imminent crash. A few other notable movers from today's session deserve attention. Pfizer edged lower by about 1.6%, a relatively mild decline that underscores its defensive qualities in a sell-off environment. SoFi Technologies had a particularly volatile session, surging as much as 4.6% in early trading before reversing course to close down 2.6%, illustrating the kind of whipsaw action that characterizes uncertain markets. These moves tell us that beneath the surface, there is active debate among market participants about which sectors and names are truly vulnerable versus which are being sold indiscriminately. Let me also address the macroeconomic picture that is driving the sell-off. The producer price data that came in hot today adds another layer of complexity for the Federal Reserve. While consumer inflation readings have showed some moderation in recent months, producer-level inflation suggests that pricing pressures remain embedded deep in the supply chain. This higher-for-longer narrative is the primary driver behind the bond sell-off and, by extension, the equity market weakness. The market is now pricing in fewer rate cuts for 2026 than it was just a month ago, which is forcing a broad repricing across asset classes. Bond vigilantes are back, and they are demanding higher yields as compensation for inflation uncertainty. Until we see a clear and sustained downtrend in inflation data, this tension between the bond market and the stock market is likely to persist, creating continued volatility for equity investors. Now here is what I am watching going forward. For conservative investors following the approach of the father of value investing, Benjamin Graham, Pfizer at current levels offers a defensive anchor with pharmaceutical stability and a reasonable valuation. For balanced portfolios in the tradition of the legendary growth investor, Phil Fisher, ExxonMobil provides both growth potential and inflation protection through energy sector exposure. For those seeking disruptive growth like the Disruptive Innovation Fund manager, Cathie Wood, Enphase Energy Solar breakout is worth monitoring for continued momentum. And for everyday investing in the style of the legendary Fidelity Fund manager, Peter Lynch, SoFi's fintech platform remains a compelling story at an accessible price point near $15. Markets may be volatile, but opportunity lies in understanding what you own and staying disciplined through the noise. The key is patience and conviction in your strategy. I'm Chloe. Don't forget to like and subscribe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.